Now, it looks like May was a pretty good month for hedge funds as they bounced back from last year's huge losses. Michelle McCory has the details from New York. Michelle?
Hi there, it's Linda. Well, as you recall, for a while there, hedge funds and those that work for them, also known as hedgies, were on the endangered species list, but they are making a comeback. Hedge funds returned an average 5.2% in May. That is the best performance in more than 9 years. And that's according to the Eureka Hedge Fund Index. It tracks more than 2,000 funds. And the industry, according to Eureka, recorded net inflows for the first time in 10 months in May, gaining $1.5 billion, while total assets rose by $5 billion. And now we're seeing all of these new hedge funds sprouting up everywhere, with young managers getting billions of dollars to put to work. At least 8 new funds plan to open their doors this summer, and between them, they will have more than $2 billion to invest. So, Linda, really, what a difference a year makes. Last year, hedge funds were closing down and really looking like they would be extinct soon. And now we're seeing 8 new funds sprout up this summer. Huss?
Hey, Michelle, who are they and how are they doing it?
Well, the majority of these new funds are really being started by young pedigreed stars with track records from banks and hedge funds. Their former employers can no longer promise them those big bonuses, so they are going out on their own. And some of their former employers are reluctant to let them go, and they're even giving them the startup money. Now, the largest fund of the 8 new ones is Rock Capital. It'll open in July with $1.5 billion. Now, Arvind Raghunathan, he's the former head of Deutsche Bank AG's global arbitrage business. He's opening this new fund. And according to people in the know, half of the money will come from Deutsche Bank. Now, here is an interesting clincher here, Linda. These new funds are offering better terms. To attract money, they are being far more investor-friendly than those industry veterans. That's according to some research by Morgan Stanley. Management fees for new stock funds are tending towards 1.5% of assets rather than that traditional 2%. And the new funds are also making it easier for investors to pull their money out. So we're not having those multi-year lockups. Also, the redemptions will be made in cash. So, there could be a growing appetite for risk. Barclays, for one, says hedge funds may get about $50 billion of the cash that investors hoarded while the financial markets fell. Now, before we get too excited, Uncle Sam may be getting involved here, and the new laws could deter investors. U.S. Senator Jack Reed is proposing acquiring hedge fund and private equity managers to register with the Securities and Exchange Commission. Now, he says that step will protect investors and reduce financial risk. But, Linda, some may see this as too much government involvement, and they may not want in. Back to you.
You know what? On the side of caution, I guess. Michelle McCory, thank you so much for that.